Welcome to Dorsey and Whitney's Bank Counsel Roundtable, Fair Lending Under the Biden Administration, a Reboot or Something Different. I'd like to introduce Nick Vlietstra, a partner in Dorsey's Finance and Restructuring Group. Nick?
Thanks, Sean. Yes, hello, good afternoon, everyone. This is Nick Vlietstra. It's my pleasure to welcome you to the November session of Dorsey's Bank Counsel Roundtable. Our speakers today are Heidi Wier and Joe Lynyak, both of whom I will introduce shortly. First, a couple of housekeeping details to go over with you very quickly. Today's program is scheduled for 60 minutes, and the materials for the presentation, as well as the attendance form, are available for download through the reminder email that was sent to you yesterday from events@dorsey.com. As was explained in that email, you should send your completed attendance form to attendance@dorsey.com. Certificates of attendance will be sent to those of you who return the completed form. Also, please note that there might not be time for a Q&A session at the end of the presentation today. If you have a question for our speakers, you are welcome to contact them directly or reach out to your usual Dorsey contact. Speakers' contact information is provided with their bios in the presentation materials. Okay, with that out of the way, let me introduce today's program. Our presentation, as Sean said, is entitled Fair Lending Under the Biden Administration, a Reboot or Something Else. We thought this topic would be of interest in light of recent indications from the federal government under the Biden administration of an intent to significantly increase the focus on fair lending issues, both for banks and non-bank lenders. This program is intended to bring everyone back up to speed on fair lending concepts, but also to discuss recent developments. Today's speakers, as I mentioned, are Joe Lynyak and Heidi Wier. Many of you already know Joe. He's a partner in the firm's Finance and Restructuring Group and is a nationally known bank regulatory lawyer. He practices out of our Washington, DC and Southern California offices. Joining Joe is Heidi Wier. Heidi is Managing Director at CrossCheck Compliance, LLC, a national consulting firm providing regulatory compliance, internal audit, fair lending, loan review, and litigation support services for the financial services industry. Heidi has over 25 years of experience consulting with financial institutions of all sizes on their compliance and internal audit needs, and her home office is in Milwaukee. More detailed bios for both Joe and Heidi are included at the end of the materials. So let me just finish by saying thank you to our speakers for joining us today, and thank you to our audience for logging into this session of the Bank Counsel Roundtable. With that, I will hand it over to Joe Lynyak.
Oh, thank you very much, Nick. Good afternoon, everyone. I hope everyone had an enjoyable and safe Thanksgiving. And we are going to be talking about a deja vu subject, fair lending, which for 8 years during the Obama administration and probably 10 years prior to that was a high priority and commitment on the part of the federal government. During the Obama administration, certainly we had the CFPB driving everybody pretty crazy on the subject. The Department of Justice with their Civil Rights Enforcement Office, again, getting heavily involved, followed by the prudential banking regulators, and then also HUD. As a result of all the pressure and emphasis placed on fair lending, lenders, and here I'm talking about not only banks, but also mortgage lenders, devoted significant resources to analyzing the patterns or evidence of discriminatory conduct based upon what we've grown to know as a disparate impact statistical analysis. And that was really where people put all of their time and effort. In the last administration, not the Biden, but the last administration, things changed quite radically, and there was definitely a dialing down of emphasis on fair lending. However, fair lending is rested, it's healthy, it's back and reinvigorated, and the Biden administration has placed a great deal of emphasis, certainly in terms of its statements regarding addressing discriminatory lending and we're going to talk about that towards the end of the program. But again, their statements publicly made have really emphasized the fact that if you haven't been doing it, you have to go back right now and look at your fair lending patterns. You know, we are very busy. I know that Heidi's group is very, very busy advising people on what you need to do. And so what are we going to talk about today? Well, it's been a while since I guess we worried about fair lending. So we're going to take a look at fair lending basis. We're going to identify the agencies that examine and enforce for fair lending, some recent announcements by the agencies on what they're doing on fair lending and redlining and other causes of discriminatory lending. Heidi is going to talk about best practices for fair lending. We're going to talk about at the end what the Biden administration is really doing, and in particular, how to assess your fair lending program in this new environment. And it probably will be a new environment, including fair lending risk assessments and performance analyses, which is Heidi's role for this panel. We're going to start out by a review of fair lending law basics, and we have naturally the Equal Credit Opportunity Act and the CFPB's Regulation B. We've got the Fair Housing Act and its regulations implemented by HUD. And then there's a whole host of agency pronouncements, joint agency statements by the OCC going back many, many years. And you can take a look at them for reference, but you'll also notice that they're probably out of date. They go back over again to 1994, and while they're still on the books, things have definitely progressed since the Obama administration. And there's at the end of this material is a host of examination and supervision policies by the federal banking agencies, as well as the FFIEC, which we would definitely commend that you take a look at for refreshing yourself as to what the regulators look at when they come in. But keep in mind that those examination policies do not necessarily represent the new emphasis that's being placed and may be placed by the CFPB and by the Biden administration. And so again, you have to keep your ears open to see what it is they're looking at and what they're concerned with. And we will get into that in a moment. The Equal Credit Opportunity Act. Well, it prohibits discrimination in any aspect of a credit transaction. It's implemented, as I mentioned, by the CFPB's Regulation B, and it prohibits discrimination on the basis of race, color, national origin, religion, sex, marital status, or age. The U.S. Supreme Court recently expanded that, the scope of discrimination based upon sex in the Bostock case, where any allegation or determination based upon sex is going to be taboo. It prohibits discrimination because of income is based upon public assistance, or because you've exercised the right under the Consumer Credit Protection Act. However, as you well know, there are some exceptions to ECOA, and this is not an ECOA course, except in regard to its prohibitions. It permits you to favor elderly applicants who are over 62 years of age, or special purpose credit programs, which we work quite a bit with in terms of some clients who are public assistance clients who come up with special needs programs to help protected classes. The Fair Housing Act. Fair Housing Act prohibits discrimination in all aspects of residential real estate related transactions. And similarly to the ECOA, it prohibits discrimination on the basis of race or color, national origin, religion, sex, familial status, or disability. In applicability, there's a great deal of overlap in the case of mortgage lending of both, in that the ECOA and Fair Housing Act both apply to residential mortgage lending, commercial mortgage lending, such as multifamily issues. The ECOA, though, also applies to all categories of lending, including commercial lending, which a lot of folks forget about, non-residential lending, And as you probably know, what's coming down the line, which may be a nightmare for commercial lenders, the CFPB has finally proposed issuing regulations to implement Section 1071 of the Dodd-Frank Act to monitor and prevent discrimination for lending to women and owned minority small businesses, which is something which then we're going to be worrying about down the line. But if you're a commercial lender, it's going to involve a lot of training on the part of your commercial lenders, but they're simply not used to this degree of compliance. We'll see what happens on that. Under the fair lending laws, a creditor may not discriminate on a prohibited basis. And discriminatory conduct includes several things in terms of what we're talking about here. Failing to provide information or providing different information regarding the availability, application procedures, or lending standards for an individual, discouraging or selectively encouraging applications, refusing to extend credit or applying different lending standards, underwriting criteria, making loans on different terms, including the amount, interest rate, or type of loan. And importantly, over the last 6 months, treating borrowers differently, either when servicing loans or exercising default remedies. And this has certainly arisen as a result of COVID and as a result of the moratoriums on foreclosures. And this is something which we'll probably be repeating several times. And I think that Heidi is going to be emphasizing data is really important to prove any claim on the part of the government that you've engaged in discriminatory conduct. Types of lending discrimination. Well, there's overt or intentional discrimination. Lenders generally do not engage in overt discrimination, such as, when I was a kid, I went to Catholic school and the Catholic nuns beat the living hell out of me, even though I deserved it. And I would not make a loan to them if they want to buy a convent. That's overt and intentional discrimination, particularly if I tell people and tell the poor nuns that we're not doing it for them. Disparate treatment. It may be evidenced by statements revealing that a creditor explicitly considered lending, prohibiting or discrimination based on a prohibited factor. It's found where differences in treatment are not fully explained by legitimate non-discriminatory factor. And this is an important point because we talk about disparate impact and we do statistical analysis, but you can also use disparate impact to prove disparate treatment, meaning intentional treatment on the part of lenders and the part of bankers and mortgage lenders. Overt intentional discrimination, really, there's overlap with disparate treatment. In overt discrimination, somebody says something where there's a great deal of evidence, but again, there's an overlap. And then you have disparate impact, where most of our efforts have really been drawn, where lending policies are applied equally on a neutral basis, but nevertheless disproportionately disadvantage certain protected persons or classes on a prohibited basis. If there's disparate impact, the lender must show that the policy or practice serves a legitimate business purpose. And evidentiary rules arose from employment discrimination cases. And you may have seen these before: Griggs versus Duke Power Company and Ward's Cove Packaging Company versus Antonio. And they're probably useful for those of you on the legal side to go about and review them, because the Supreme Court harkens back on them when they make their determinations. In terms of disparate treatment, the disparate treatment alleges a linkage between the discrimination and a prohibited basis in a manner that the creditor's decision-making process resulted in the individual being treated differently because of the identified prohibited basis. You can have direct evidence. I don't like nuns, okay? Or you can have circumstantial evidence, statistical regression analysis, disparate treatment analysis, membership in a protected class, an application for credit for which the borrower was qualified and yet did not receive the credit, rejection despite qualification. Creditor continued to approve credit for similarly situated applicants. Matched pair analysis. Again, this is disparate treatment. We may be back to those days. mystery shopping. And again, we may be back to those days. Remember those, again, about 20 years ago that we were doing. And a modified test is necessary to prove reverse redlining, which we're not going to get into today, but is certainly a cause of concern. And then you have disparate impact. In a disparate impact case, the borrower has not been treated differently based upon a protected class basis, but the effect of the creditor's practices, lending practices, is to adversely impact the protected class. Traditional disparate impact has been proven by a statistical comparison of the acceptance rejection results of a protected group within the accepted rejected results of all applicants in the loan pool. Courts have also employed the but-for test. But for the status of the applicant or borrower as a member of a protected class, the applicant borrower would have received financing or funding at a cost, at a more favorable cost to the borrower. While some lenders argued that disparate impact was not available to prove a fair lending claim based upon some ambiguity in the ECOA and FHA, and there was a little bit of ambiguity in terms of the way that the discussion was based, that position was soundly rejected by the Supreme Court in the case of Texas Department of Community Affairs versus Inclusive Communities Project. And people refer to it generally as the Inclusive Communities test. The court held that a disparate impact analysis is available to provide a fair lending violation. Importantly, the court identified in that case a burden shifting test that should apply. Now, after that decision, creative minds in the Trump administration interpreted the Inclusive Communities decision in a manner that arguably diminished the effectiveness of a disparate impact analysis by sweeping changes in the burden shifting test. And you have here some of the citations and the Trump administration and HUD's implementation of that test. That rule was almost immediately adjoined by a federal court and never came into, never took effect. After the end of the Trump administration on June 21st of this year, HUD has proposed to formally rescind the Trump area rule and to restate its 2013 rule on disparate impact. And that's a major change. It is in the process and certainly is going to be adopted by HUD. What does it mean? Well, as I said, I mentioned that there's a burden shifting test. And first, the plaintiff bringing the claim has the burden of proving that a challenged practice caused or predictably will cause a discriminatory effect. Then the burden shifts over to the defendant. Once the plaintiff is satisfied his burden of proof, the defendant has the burden of proving that the challenged practice is necessary to achieve one or more substantial, legitimate, non-discriminatory interests of the defendant. And then finally, if for whatever reason that is successful, the plaintiff may still prevail upon proving that the substantial, legitimate, non-discriminatory interests supporting a challenged practice could be served by another practice that has a less discriminatory effect. And so you can see how this is a pleading case where the burden goes back and forth. And again, data is absolutely crucial to prove both the plaintiff's case and also in defense, the defense case. Who examines and enforces the fair lending laws? Well, there's an overlap. The CFPB has the primary authority to enforce the ECOA against financial institutions. And that includes banks, credit unions, and other depository institutions over $10 billion. And there's a list there which you can go take a look at. It's about 110 lists of banking institutions and a few credit unions that are now over $10 billion. And in addition, they've got direct supervisory authority over mortgage lenders, mortgage servicers, keep that in mind, payday lenders, and virtually all non-bank lenders. Coincidentally, at the creation of the Dodd-Frank Act, within the Dodd-Frank, it created the Office of Fair Lending and Equal Opportunity, which critics claim was eviscerated by the Trump administration, and its role diminished and its authority diminished. Well, again, that has been reversed. They're now back, and there's been a general reorganization of the CFPB, which has reinstated this office's authority, and they are moving forward. The federal banking agencies, the prudential regulators, have primary examination for banks $10 billion or less, and that's the vast majority of banks in the United States. However, they have got concurrent authority with the CFPB. The CFPB has the ability to look over their shoulder and effectively do whatever they want if they want to, when they want to. And that includes banks, bank holding companies, and affiliates. But generally, the dividing line is the CFPB has got the big banks. The smaller banks are under the prudential regulators' authority. And keep in mind that we're not talking right at this for this session on state governmental authorities, because in just about every state there are similar fair lending laws which are going to generally mirror ECOA or the Fair Lending Act, and yet they also have to be looked at. I will note to you that recently the California Department of Financial Protection and Innovation was reorganized, given this new name, and given direct authority to enforce the federal protective laws, consumer protection laws, which would be the ECOA, not going necessarily through the CFPB to ask permission, but to do it directly. We're going to see how that plays out. Historical and new categories of lending discrimination, again, is an important development. And here are some of the things which recently have come up, which have been raised by representatives of the Biden administration. Refusing to make a mortgage loan or to refinance a mortgage loan. Redlining, big deal. Now remember, redlining generally refers to banking, does not refer to non-bank entities. However, if you read some of the pronouncements closely, you will see where some people will argue that redlining is broader than the scope of what redlining normally was referred to when you're talking about banks taking deposits, not making loans in communities. And so again, it's become somewhat of a more fuzzy term. Reverse redlining, refusing to provide information regarding loans, imposing different terms or conditions on the loan, such as different interest rates, points, or fees. Discrimination in appraising property. Again, it's become a bigger issue, and it has become and there's been notoriety given to that recently. Refusing to purchase a loan or set different terms and conditions for purchasing a loan. Again, kind of unusual the way that that's been raised, and yet that's out there. And then general category of discrimination in providing other financial assistance for the purchasing, construction, repairing, or doing anything relating to a dwelling, or other financial assistance secured by residential real property, kind of a catch-all. We know it when we see it. Two new ones: maternity leave discrimination. We're not going to give you credit to take maternity leave, and therefore we're not going to give you a loan. Or disability discrimination under the Americans with Disabilities Act. And again, new concerns, new alternatives for discrimination. The TruSmart recent agency actions, the TruSmart National Bank, and this has received a great deal of notoriety. However, it was a 4-year investigation, and it finally occurred, and it was brought by the government, discouraging prospective minority borrowers from applying. This is a national bank. I believe it's got about $13 billion in size. It avoided establishing branches in minority communities. And this is really a CRA issue, in that you cannot just simply draw a circle around a discrete community and not branch into it. Whether or not that applies to a non-bank is a good question. It's difficult to get there, but you can certainly see how the regulators would probably want to say, yes, you should be doing it. hiring minority loan officers, so discouraging applications. Now, even though these things were very terrible in terms of what they were alleging, the resolution of it was, frankly, not what you would expect if we were going back 8 years to the Obama administration. They paid a $5 million penalty. They agreed to invest in a less than a $4 million loan subsidy fund to establish a loan office in a minority area and to do minority outreach. And again, after 4 years, that was the settlement of it. I would suggest to you that when you read over the complaint, you would read it and say, wow, this is really not necessarily a disparate impact case. This is a disparate treatment case, because most of these things involve treatment of discrete minorities as opposed to impact minorities. As a result of that case and a few other things, the DOJ and Attorney General Garland announced a commitment to prosecuting redlining, creating a partnership with the Civil Rights Division and the U.S. attorneys, and newly approved Director Chopra announced a redlining focus. He expressed at the same time concerns about underwriting algorithms and artificial intelligence in the underwriting process. And they actually had two, frankly, relatively minor fair lending enforcement orders, but they promised to increase the referrals to the Department of Justice. So that's about where we are. And before I turn it over to Heidi, I would raise with you two questions which we can revisit at the end of Heidi's presentation. Are the legal theories of discrimination different, or are they new? And what data do you need to focus in on, be concerned with to defend yourself against an allegation of discriminatory conduct? And with that, I will turn it over to Heidi, who's going to tell you what you need to be looking at your shops.
Great.
Before I do that, excuse me, Heidi, my mistake. I got to give you the super secret code. And what I do not see here is the super secret code. I will get that for you and announce it for you at the next break, since apparently we forgot to put it in here, but I will then now turn it over to Heidi.
That's the secret code for the CLE credits. Is that what you're referring to?
Yes, it's super secret.
Got it. Okay. All right. Well, thank you. Anyways, while you're getting the secret code, I'll go ahead and get started. I'm going to talk about really three focus areas for fair lending: risk assessment, fair lending program, what you should have in your fair lending program, and then the performance analysis, or what to do with that data that Joe was talking about. So I'm going to start with the fair lending risk assessment, and you'll see here, the factors that affect fair lending risk. You really need to understand the products and services that you're offering, how they're offered. So what channels they're being offered through, online, in person, how are you offering those products? And then who are they being offered to? When you think about it, you want to think about the whole process from cradle to grave. So the entire life cycle, right? So customer intake or customer acquisition, your marketing efforts, all the way through that, that loan payoff, or maybe it's a loan write-off, or maybe you're selling the loan. So cradle to grave, right? Fair lending from the entire process. So if we look at each of these items on this slide, right, the first one, the fair lending program on the left, I'm going to skip that because we're going to talk about that in more detail in the next piece here. So I'm going to start with policies and procedures. You want to make sure that your policies and procedures are clear and they don't leave a lot of room for interpretation. Be sure that there's no obvious issues with them. I know last year the FDIC referred a case to the DOJ that related to a lender's policies around providing different pricing for married joint applicants or unmarried joint applicants, right? For married applicants, the policy was going to be that they were going to use the highest credit score of the two. For unmarried applicants, the policy stated that they were going to use the middle score for the middle score of the main applicant. So just based on the policy themselves, there was different treatment for married and unmarried applicants applying jointly. So make sure that you're going through those policies and looking for anything that, on the surface seems like an easy catch. Discretion and exceptions in your policy. There's been a lot more focus around exceptions from the regulators. Make sure that if you have discretion and you have a lot of exceptions that are allowed, that you try to put a box around that as much as possible. If at all possible, you want to eliminate discretion. If you need it, things like matching a competitive price situation, make sure you can, to the extent possible, put a box around that, restrict it. Who's able to make pricing exceptions? Does it have to be approved? What sort of documentation do you have to have with it? And then make sure that those are flagged somehow so that you can produce a report showing all of the exceptions that happened, and you can analyze that exception data, because you're going to want to look to see who's getting exceptions, who's not getting exceptions. Are exceptions being granted across the board? Is there any, are there any disparities in that process? Are there any, any prohibited basis groups, for example, that might not be getting the same type of exceptions that your control group might get? You also want to look at third parties. There's a lot of fair lending risk involved in third parties, brokers, correspondents, servicers. We know Joe mentioned servicing is a hot topic with the regulators, fair lending and servicing. We just saw Cenlar, right? One of the largest subservicers get hit with a big consent order. So don't assume just because you're using one of the big third parties that they're necessarily doing it right. You really want to make sure that you're doing your due diligence and that you're comfortable that those third parties are doing everything right and that you're monitoring for that. There was also a third party credit score model, right? There was another referral, I think the FDIC made it to the DOJ regarding a third party credit score model. This particular model, I think, scored younger applicants more favorably than elderly applicants, which of course we know you can't do with discrimination based on age. So again, make sure you do your due diligence. And if you have a vendor that can't or won't explain the attributes in their their model, for example, you really might. It's something you really want to be concerned about. You really want to dig into and make sure that you're doing your due diligence for things like that. And then, data integrity and insufficient monitoring. We're going to talk more about data integrity because, of course, you have to have good, accurate data, right? Garbage in, garbage out. And so we're going to talk a lot more about that in the next section as well. Incentives and compensation plans, they can also add to your fair lending risk. We saw a lot around that quite a few years ago now with Wells Fargo, but you want to make sure that you're not incenting your personnel to steer people to do anything inappropriate. Make sure that that the incentive programs are compensating folks the way you want to, and not incenting bad behavior. Marketing risk. Certainly, when you're evaluating your risk for fair lending, you need to consider your marketing risk. You need to know, who are you marketing to? Where are you marketing to? What products are you marketing? Are you only marketing, primarily in white census tracts, or do you include, high minority census tracts in your marketing campaigns? Do you market higher risk products in higher minority census tracts, right? So maybe if you offer insurance products, are you only marketing those in high minority products? Or maybe ARM loans, right? It's debatable whether ARMs are considered, a less advantageous product or not, but certainly the regulators have looked at it as sort of a less advantageous product. So, who are you marketing ARMs to? And are you marketing ARM loans, adjustable rate loans across the board? You also want to ask yourself, who does your marketing appeal to? Are you using models and people in your marketing and your pictures that appeal to everybody in your market area? If you're only showing, white families, for example, with big, large houses in the background in your ads for your home equity lines of credit, who is that appealing to, right? White families with big, large houses. Is that going to appeal to the broader market? So you want to just make sure that you're marketing and you're using models and tools that appeal to the broader market and the market that you serve. Even though this particular slide focuses on originations, there's a lot of other risks that you need to consider as well. So servicing risk right now is a hot topic. Joe mentioned that as well. I think he also mentioned appraisal process. There is a concern around bias, racial bias in appraisals, and we know the CFPB is focused on that. And so as you're looking at your third-party vendors, that might be something that you want to look at as well. When you do your risk assessment, you want to make sure you have a documented process for fair lending. You should update it every time a major change happens, and at least annually, I would say. So you want to make sure that your fair lending risk assessment is documented and updated periodically. All right, I'm going to switch now to the next slide and talk a little bit about your fair lending program. Okay, so let's switch a little bit and talk about your fair lending program. There's a lot of overlap between your fair lending risk and your fair lending program, right? It's kind of like which comes first, the program or the risk assessment, or is the program based on the risk assessments or vice versa. So no matter what order you do it, you want to make sure that you have both. You want to have a strong fair lending program and obviously the fair lending risk assessment that we talked about. Your program is going to include not only fair lending risk items that we discussed, it's also going to include things like your data analysis process, your policies and procedures, all of those CMS things, so those compliant management system things that we talk about related to compliance in general are also going to apply to your fair lending compliance. So things like board management oversight, making sure that you're reporting things to the board and that those reports are documented in the meeting minutes, monitoring and testing, fair lending training, marketing materials, all of those things that you would typically include in your CMS. You're going to want to make sure that you're including specifically in your fair lending program as well. Other areas that we didn't talk about maybe in the risk assessment, but you should include would be like change management. Who's keeping track of new regulations? Who's preparing for those? Who's making sure that those changes get operationalized in your organization? And so you want to make sure that that's addressed in your fair lending program also. And then credit risk. We touched on that a little bit already, but I'll emphasize that again, right? Credit, who's getting loans, who's getting exceptions, how detailed are your policies and procedures, your underwriting practices, making sure that you're reviewing and eliminating as much of that risk as you can. Okay, so then I'm going to switch to the next slide and talk a little bit about data. We know the regulators are going to be looking at your data. And so it's really going to be important for everybody to understand what that data is going to tell about your fair lending performance. And so I would really recommend that you all look at your data before the regulators do, right? You want to know what that story tells and what that data tells and start being able to react to it. Build your story based on what that data tells. The first thing I talk about here is with HMDA data. One of the things that you also need to do with your data is you need to make sure it's accurate. And so it starts with data integrity. So I'm going to focus just a little bit on data integrity and what some of the things are that you should be looking at in your HMDA data. You can do either sort of manual HMDA data testing or systemic testing, and depending on the size of your HMDA LAR, I would really recommend systemic testing. Good thing about systemic testing is you can look at 100% of your LAR, and you can look at that for multiple different ways. Different validation tests or logic tests for logic validation, omissions testing. Basically, some things that you would want to start out with would be to compare your data on your LAR to the data in your LOS system or your loan origination system. So when I talk about like logic testing on that, basically what I'm suggesting is that you would compare your LAR data to multiple fields in your system data to make sure that it's in logical order. So the example that I show here in the slide talks about your application date. So you could compare your application date to multiple different things in your LOS system. Things like the date your loan estimate, your TRID disclosures went out, the date that you got the intent to proceed, the date the file was started in the system. And you're looking at all of those different fields for logical order, right? Your loan estimate should go out on or after your application date. Your intent to proceed should be on or after your application date. Your date in the file should be on or before your application date. So just kind of a series of logical validation tests that you can do and that you can build to validate all of that data to make sure it's accurate. There's definitely some other tests you can do. So for example, like loans denied for DTI, but there's no DTI reported, or a denied application that has an approved code in the AUS field, or, there's lots of different ones you can do. Maybe if your particular company has an issue with, applications being considered withdrawn, you can look to see if you have withdrawn applications that are 60 or 90 or 120 days from the application date to the date that they were withdrawn, to see if there's something in that data. Maybe there's more to that you can look at to validate whether or not that information is accurate. So anyway, so there's a lot of tests you can do and you can create. So you can really be creative when it comes to validating your LAR data. The other thing that this kind of testing can do is it can help you identify if you have any applications that you've omitted from your LAR, so that you failed to include. So really, with a reconciliation of your LAR to your LOS, identify anything that's on your LOS that's not on your LAR, and start looking at those things to see if there's a good reason for them not to be included on your LAR. And there are some good reasons, right? Maybe they were a lead and they never made it to application status. But on the other hand, you want to dig into those because maybe they really were an application that should have been included on your LAR. Okay, and then on the next slide, I talk a little bit about outliers. You also want to look at your data for anything that's, basically a high side or a low side outlier. So whatever is typically normal or normal for your particular company, you want to look at the data to see what's, much lower than what you would have expected to be normal, or what's much higher than what you would have expected to be normal. So again, examples, your DTI is too low or too high. So if you had a DTI that was 98%, for an originated loan, you'd probably want to look at that, because a 98% DTI for a loan origination is probably not that normal. The other side of that too, right? If you had a DTI that was 25% or too low, and that loan got denied for DTI, that seems kind of odd, right? It wouldn't get denied for DTI if your DTI was low. So some things like that. Other examples might be income, right? What's your lowest income on your LAR versus your highest income on your LAR? Does that make sense based on your market? Does a $2 million income make sense, or is there an extra zero? Maybe it is $2 million. If the $2 million income is getting a loan for $180,000, does that make sense? Or is there an extra zero in that income? So again, high side, low side things in the outliers in the data are things that you're going to want to look for. And so far, we've only been looking at your data compared to your own data, right? So you're looking at your data compared to your LOS and what's normal for your entity, your company. And the next thing you're going to want to look at is you're going to want to look at your data compared to the national aggregate data. So on the next slide, actually, I give you an example here. In the first column, I have the national aggregate data. And then in the next two columns, I have basically two potential lenders, lender A and lender B. And you want to look at your data compared to the national aggregate data. And in this case, I kind of highlighted it in here in red. The national aggregate denial rate is about 11%, 11.21%. And the national aggregate withdrawal rate for this sample is 13.29%. And then if you look at lender A in this particular example, you'll see that lender A's denied rate is 3% and their withdrawn rate is 29%. Both of those numbers are far different than the national aggregate. So if that was my company, I would want to look and see, okay, what's making that so different than everybody else, right? And, at least initially, perhaps that would mean the 3.5%, maybe things are being coded incorrectly, right? So maybe you have denied applications that are being coded as withdrawn. So that's causing your denials to be too low and your withdrawals to be too high. So potentially that could be a concern. And then if you look at the next one, column B, 85% of column B's or lender B's records are reported as either originated or approved not accepted, compared to about 62% of the aggregate. So in that case, perhaps that means that they also have only 2.5% that are being denied. So in that case, maybe they have an issue between what's being denied and what's being reported as approved, not accepted. So those two numbers might be flipped. And so there might be some investigation that you want to do there. The next slide talks about disparities based on distribution by race. And so you'll see here, we have basically that aggregate data. And then we also have lender C, in my example, who has, race not available for 44.8, almost 45% of their data, where the national aggregate is about 23%. So if I was lender C in this particular example, I would want to look into that to say, okay, why are we not able to get race information 45% of the time? And is there a problem? Are we not collecting it? Or are lenders not asking for it? Is there some operational procedure that we have to fix or change to get that data to be more accurate? Because otherwise, that you would be open for potential criticism by the regulators for not having that data, basically not reporting that data. Okay, so now you've looked at the data based on, your LAR, your LOS, the national aggregate. You also want to take a deeper dive and look for some disparities in outcomes. So I'm going to have Joe switch to the next slide. You want to look for potential disparities between your control group applicants, who are typically going to be white or males, right? So your control group typically is white and males. And you look for disparities between that control group against all of your other applicants. So you're looking for disparities in things like underwriting. Understand who's getting approved, who's getting denied. If your control group is getting approved at a statistically significant different rate than your prohibited basis group, that's something that you're going to want to take a deeper dive into. Same thing with pricing disparities. Pricing disparities analyze differences between APRs, fees, other charges. So you're going to want to make sure that you understand who, if there are significantly different disparities, who are those, who's getting the benefit of that, right? Is it your control group? Or are the disparities significant based on a prohibited basis group? You're going to want to look at disparities in the levels of assistance. So really what that means that if you have a control group that's receiving decisions, so for example, if you have a control group that's receiving decisions quicker, maybe they're getting their, from application to loan closing, it's taking about 30 days, but a prohibited basis group, it's taking 60 days. That could be, some interesting data to take a deeper dive into. It could be, if your withdrawal rate or your fallout rate is taking much longer or much larger, it could be that maybe they're getting ignored and they're not getting the right levels of service, or they're not getting consistent levels of service. And so they're just getting ignored until maybe they go away. So levels of assistance is one of those disparities that you're going to want to look at as well. And then steering, right? If you have potential disparities in your steering, are applicants being placed into a particular product, maybe a less advantageous product? Government loan sometimes might be considered, there might be steering into a government loan product. Again, I kind of mentioned adjust for it mortgages that perhaps could be considered a less advantageous product as well. So is there any steering happening there? And then redlining. Redlining is, the CFPB, everybody said that's going to be a primary focus. So even if you're not at a bank, I really would recommend that you look and understand your data around redlining. Are there any gaps in the areas that you're lending to? So look at census tracts with majority minority populations or high minority populations. And are you making loans evenly between those different demographics? They say a picture is worth 1,000 words, and I think redlining is so much easier to see when you can see it in a map. So ideally, you would be able to map your lending practice, all of your lending performance, basically all of your loans and applications by census tract, and then highlight those census tracts by the minority majority makeup of the census tracts, so that you can really see if you're skipping any areas, right? If you have those minority census tracts, usually shaded in a different color, and if you have all of your lending plotted out on that map, you can see if your lending is evenly dispersed through the different areas, or if you have any gaps in your lending. And certainly if you do have any gaps, those are the things that you would want to take a deeper dive in. All right, the next slide is, without getting too deep into the regression and the statistical side of things, this slide really outlines at a very high level that process of statistical and regression analysis. If if statistical significant disparities are noted in your data set, typically if the data set is large enough, we would want to build a regression model based on your policies and your guidelines to see if we can regress out any of those disparities, so to speak. Once we go through that regression process, if there's still, if those statistically significant disparities remain after regression, we would typically be looking at then to identify similarly situated files for that comparative file review process, matched pair testing, right? So if you can't eliminate the potential disparities in the data, ultimately, it does come down to opening up those files and identifying those matched pairs and digging into those files to see, what the explanation is for the differences in the outcome. Sometimes, like levels of assistance, you're not always able to do matched pair testing, so you're really then just looking for files that have unexpected outcomes. So an outcome that is different than what the model and your statistical model would have predicted. So, for example, if you have two applicants, right, that are both similarly situated, you're going to want to dig into those files and say, okay, so the data looks like they're both, situated the same way. Why did one really get denied and why did one get approved? And hopefully you're going to find something other than, disparate treatment as the answer to that. So, perhaps one, you would dig into the file and you'd see something was wrong with the, the foundation of the property, right? There's not going to be a data element that's going to capture that. So really you have to dig into that file and look for those things that aren't captured in the data that might explain why you got a different outcome. All right, so I know I covered a lot of information here. I'm going to turn it back over to Joe for those last two slides. And then Joe, I don't know if you have, if you're going to open it up to questions, or I know you have a couple of slides to cover there.
Okay, that was a lot of material, but extremely important material. Great job, Heidi. I think one of the things which everyone at this presentation understands is it's better to be doing a look-see now as opposed to getting a CID from the CFPB. For any of you that have been unfortunate enough to get a CID where they lay the lumber on you, you're doing all of this work, you're doing it in a very, very stressful environment. It can take an enormous amount of time. It can be extraordinarily expensive. And you also run the risk of the CFPB in terms of Heidi's outline of things which could indicate discriminatory conduct. They can certainly be shifting from topic to topic till they find something that they think is actionable. And when you have the force of the federal government coming down on you, you immediately throw up the white flag, surrender, and do whatever is necessary in order to resolve it. Fighting, as we were talking about at that recent bank enforcement case over a 4-year period, you're going to die on the battlefield. And so what you want to do is you want to be able to tell a good story, and you want to try to resolve things. But let's try to throw some things together here, and maybe Heidi can give her perspective. The Biden administration, as we've mentioned several times, has indicated it is going to enforce the fair lending laws, and Director Chopra has emphasized redlining, fintech, and AL. And they keep saying it, and they keep saying it, and they keep saying it, and it kind of reminds me of the movie Miss Congeniality with Sandra Bullock, where she's an FBI investigator and she's a beauty pageant contestant, And when she's being interviewed, it doesn't matter what she says in terms of her answer. She's got to answer by saying, end world peace. Well, that's what they're doing now. They're saying whatever they're talking about, they have to end up by saying in just about every context, not world peace, but discriminatory lending. We're going to be looking at that and redlining. And while I'm being somewhat flippant about it, it really does raise the question as to whether or not the CFPB, which prides itself on being data-driven, is really being moved by the data, or whether or not they're making it up out of whole cloth. And the reason why I say that is that if you take a look at the recent reports put out by the CFPB and by others, there have been, particularly, like, let's go back to 2020, very few enforcement actions by the CFPB, very few Department of Justice referrals. Really, not a lot of things to be worrying about. And when you take a look at the reports by the federal prudential agencies, again, for the Department of Justice referrals, 12 referrals. A handful of them to the DOJ. When it talks about ECOA violations found, only 81 of them out of over 5,000 banks. Now, are there HMDA problems? Yeah, there's always going to be HMDA problems, and certainly a starting point is to make sure your HMDA data is strong. But the question remains as to whether or not this is the Biden administration's response for fair lending to and world peace, as opposed to, is there really something there that we have to worry about? Now, thankfully, as lenders, we have been doing a very, very good job over the last several decades in looking at HMDA data and crunching data. And I think compared to non-mortgage lenders, we're in very, very good shape. But I also raise with you the fact that the New York University issued a report, which we've got a reference here, and that Shelper is talking about. Well, I'm really concerned about fintech and AI underwriting, and they looked at it in context of the PPP program, and they found that it worked pretty well, and there was actually less discriminatory conduct when you're using fintech and AI underwriting than hands-on underwriting by some banks. And so, where are you getting this all from? And should we be taking a step back and thoughtfully looking at the scope of what is really taking place here, and is there really an actual problem? I will say, however, that when you take a look at the comments that have been issued recently, a lot of them really are not focused in on issues relating to disparate impact. They're looking at issues relating to disparate treatment. And I would welcome Heidi's comments. I would say that if you're starting out to take a look at what you have been doing recently, before you really get into the weeds on disparate impact analysis, take a look at what your treatment issues are, from the application to processing to loan servicing, and do an audit to see whether or not they stand on their own and they're supportable, because I think that there's going to be a high likelihood that that's going to be the crux of a lot of the enforcement actions. Because remember, you can also use regression analysis to prove disparate treatment. And a lot of the things being alleged really may fall into the disparate treatment category as opposed to the disparate impact category. Heidi, thoughts?
Yeah, I agree. I think another, as you said, right, it's more than just HMDA. HMDA data has always been there and will continue to always be a focus area. So you need to focus on that. But it's also your other lending, right? Commercial lending, indirect auto lending, consumer lending. You want to be able to understand what's in that data as well. So I didn't mention it before, but I know regulators are using Proxy Data to geocode, basically to get the demographic information for other types of lending. And so usually it's the Bayesian improved surname geocoding, where you're basically assigning the demographic information by geocodes, census tract, basically geographies, as well as your surname, and then doing the same sort of fair lending analysis you would do with that proxy data that historically we've done with HMDA data. And so being able to assign that proxy data to the other types of lending, because the regulators are certainly looking at more than just HMDA and mortgage lending these days. Also things like complaints. We saw the regulators are starting to analyze complaints by geographies. And so really kind of taking those concepts and expanding them and taking a deeper dive into them to potentially see if there's more of an impact out there than what we've previously been dealing with, and more of an impact than just HMDA data.
Well, we are just about out of time. You can see here some examination materials which can be helpful for outlining what they will do to you when they come in to talk with you. And Nick, are you going to be jumping in here and saying goodbye to our guests?
Yes, here I am. Thanks a lot, Joe, and thank you, Heidi, for that great presentation. Thank you also to our audience for your time and attention. Again, if you have any questions for our speakers, contact them using the contact information that's in the presentation materials, or you can get in touch with your usual Dorsey relationship contact. I also want to point out our next meeting of the Roundtable is planned for Tuesday, December 14th. So that's just a couple of weeks away. We'll be covering trends at the SEC, FinCEN, and CFIUS. Invitations have already gone out, so let us know if you haven't received yours or if you can't find it. So thank you again, and have a great evening.